Good morning. So myself, Dr. Jinu Kurian, basically a sustainability practitioner, and currently I'm a faculty with the Technology Management Department of MBA NMIMS, which is located at Mumbai, India. So this research project is part of a research which is undertaken by my students under my guidance, who are S.Shwetha, Mohammed, Rishabh, and Daivik. And it is titled as The Impact of Shareholder Activism on ESG Performance in India's Banking Sector. So I thank OIDA for giving us an opportunity to present our work at the 22nd International Conference on Sustainable Development. Now, moving forward, this would be the flow of my presentation: introduction and background, followed by methodology, key observations, and conclusions. So on a global scale, investors are not just focused on financial returns, but mainly the corporations, they urge to undertake meaningful action on the environmental, social, and governance parameters. So especially in the banking sector, this has serious concerns because now the sustainability scenario is very well matched by the financial sector as well. And since there is an increasing concern to the global climate change and sustainability regarding the SDGs and achievement of the SDGs, there is this shift and the importance where the distraction in areas like banking, where risk associated are more, and the governance is more to focus on such areas of risk and the environmental governance parameters. So this trend is gaining momentum in India, and SEBI and RBI have issued new guidelines like the Business Responsibility and Sustainability Reporting Indices and Climate Risk Management Guidelines. So the vast majority of academic work has focused on shareholder proposals and voting statistics, but has not addressed the post-ballot phase. So shareholders' activism and its true impact at whether banks will take action on the ESG issues raised, and at the post-ballot phase, this is not being investigated much. So this necessitated us to study this post-ballot phase, and the research focuses on the post-ballot phase of shareholder activism, investigating how Indian banks responded to ESG-related shareholder actions, especially from the period 2020 to 24. So given the increasing recognition of ESG factor as critical determinants of sustainability practices, this research seeks to explore how specific aspects of activism such as proxy voting, institutional investor proposals, and regulatory pressures contribute to ESG in the Indian banking sector. So additionally, it examines the impact of recent regulatory developments on shareholder activism and its implications for investor trust, bank valuation, and long-term operational strategies. So by addressing these inconsistencies in ESG disclosures and assessing the tangible effects of shareholder activism, this research aims to bridge the existing knowledge gaps and provide empirical insights into the evolving role of activism in shaping sustainable banking practices. So mainly the research objectives which we coined were to empirically examine the impact of shareholder activism on ESG practices of Indian banks between the time period 20 and 24, to analyze and quantify the extent to which shareholder activism influences the key basic bank parameters or indicators in ESG, including the environmental, social, and governance practices, and to evaluate the moderating effects of regulatory changes and policy interventions by RBI and SEBI on the relationship between shareholder activism and ESG outcomes within the Indian banking context. So there is limited research on shareholder activism influencing the environmental performance, especially in the Indian banking sector. And the sector-specific challenges, recent activism trends, and the balance between profitability and the long-term ESG goals, these are yet lacking in the academic scenario and in the past research, which we have analyzed through a literature review. Hence, these gaps were taken forward in our study. So the variables which we selected for the study, the independent variables included institutional investors, engagement intensity, and proxy voting outcomes. And the data sources for each of these are also shown here. Now, the dependent variable which we selected was the ESG performance scores. That is the overall environmental, social, and governance scores. And we looked into each of these parameters. And the moderating variable selected was the regulatory environment. Introduction of ESG guidelines and mandates were reasons for the selection of this regulatory environment. Again, data sources for all these variables are also mentioned here. Now, certain variables we depicted as or selected as the control variables, which are bank size, financial performance, then return on equity, ownership structure, CAR, and the NPA ratios. Now, going forward, the methodology included a mixed method approach, which combined the quantitative and qualitative research aspect, and the design was panel data regression analysis was used, and the sample selected included 10 to 15 Indian banks based on market capitalization. And the analytical techniques which we used mainly consisted of the thematic content analysis, then the triangulation techniques which we used in the qualitative findings, interpretation and analysis, then cross-validation and robust interpretation of the findings, panel data regression, both the fixed and random effects models were used, then robustness checks were carried out by VIF and Hostman test. Then additionally, some qualitative methods were also used to analyze the interviews and discussions which were taken as part of the surveys. And the data sources here included the ESG scores mainly, which were sourced from the Sustainalytics, MSCI data, and Refinitiv. And bank financial statements and the annual reports were also taken. Then the CSR reports were also referred to. Proxy voting records and institutional investor proposals, along with the ESG reports and sustainability reports of the various companies. Then other data sources included the shareholder proposals, AGM minutes, regulatory filings, and press releases. So the secondary data as well as the primary data was used to some extent. Now, so the data was collected and it was analyzed using the various techniques which I mentioned. And this shows summary statistics of the result. So here you can see that the various parameters, how the summary statistics evolved. So return on equity showed a mean of 8.11, and the values range from as low as 0.14 to as high as 17%, whereas the capital adequacy ratio averages around 13.42%, and total assets and market capitalization also display wide disparities. Then profitability metrics such as ROA with a mean of 0.82% are modest on average, which is expected in a highly regulated sector like banking. Asset quality as indicated by the gross and net NPA ratio shows that bank face substantial credit risk. Then the gross NPA peaks at 14.45% and net NPA at 6.35%, highlighting the importance of risk management and its ESG impact. Now, environmental and social governance scores when we looked at, the environmental scores range from around 2 to 47, indicating a wide disparity in the environmental initiatives across these banks. Social scores are moderately distributed. Mean is around 28.97, reflecting different levels of focus on social outreach and inclusion. Governance scores are relatively more stable, but still range from around 9.1 to 28. So the overall ESG score has values ranging from 19.1 to 49, suggesting variation in holistic ESG integration. So these statistics indicate substantial interbank heterogeneity across the various financial and ESG parameters, and this justified the use of panel regression to model the relationships. Hence, we use the panel regression as a model to, depict the relationship. Now, this figure shows the correlation metrics, correlation analysis of the various parameters. So strong multicollinearity was observed between the ROE and ROA, which is around 0.92, and ROE and log market cap, which is around 0.93. Then between gross NPA and net NPA, which is at 0.96. However, negative correlation with the ESG score was shown by the parameters ROA, which is 0.49, CAR with a value of 0.31, and log market with a value of 0.43. So this negative values implies that higher profitability and market valuation might not directly translate into a better ESG score. So this was also a unique finding which we had with the observations. Then positive correlation with the ESG score. So gross NPA was showing a positive correlation at 0.42. Now, this could indicate that banks with higher NPAs are more aggressively reporting or enhancing the ESG disclosures. However, low of total assets shows weak correlation with ESG, that is around 0.22. That means size of the bank may not have strong influence on the ESG score, especially for this sample. So this is limited to the sample which we have taken in this case. However, these are the indicative results for the same. Now, this figure shows the proportion of ESG score explained across the banks. So this selected model explains 51% of the variation in ESG scores across banks, which is strong for cross-sectional panel data. So the remaining 49% is unexplained, possibly due to various factors which are not included, or maybe due to some of the metrics which were used in the qualitative metrics. So the constant term is significant in both pooled OLS and fixed effects models, which is expected from a baseline framework. Now, when we did the component-wise ESG analysis, so the scores showed are for environmental, social, and governance, the R-square values are here. That is, the R-square values for environmental is 0.4823. So none of the predictors were statistically significant, and the environmental scores may depend more on the qualitative disclosures or maybe some other parameters in the framework. However, social scores, the R-square value is 0.5862. So here, log total assets, gross NPA and net NPA emerged as significant, which shows larger banks with better risk performance appear to score higher on social inclusion and the impact metrics. Then governance showed a value of 0.9468. This was the most explainable component with strong effects from ROA, CAR, market cap, and NPAs. So this reflects that governance quality is tightly linked to internal financial discipline and performance transparency. So this is the analysis of it and the coefficients for the predictor variables. Now, to summarize the results, here we have the model performance, which showed that the pooled OLS model was the most reliable one, explaining 51% of the variation in overall ESG scores across 10 major Indian banks from the period 20 to 24. So this period is very significant because this was where the emergence of ESG and sustainability parameters, especially in the banking sector, emerged, especially in the emerging economies like India. Then the fixed effects and random effects model had low explanatory power and insignificant coefficients with R-square values close to 0. Now, considering the key predictors of ESG performance, we saw that gross NPA showed a strong positive correlation with p-value 0.001 with ESG scores, potentially indicating increased ESG disclosure and reputational efforts among banks with higher distressed assets. Now, net NPA had a negative impact on ESG performance, particularly governance, suggesting unresolved credit risk dimensions and which impact actually the bank's ESG credibility. However, low market cap exhibited a negative correlation with ESG scores, implying larger banks may face more scrutiny or lag in ESG adoption despite greater resources. So the component-wise ESG analysis, we had seen that governance has the highest explanatory values and social scores showed moderate values, whereas environmental scores showed weaker correlation. So this means that banks had to, improve upon focusing on the various environmental parameters. However, social and governance issues are still taken forward, but they are lacking in the environmental scores. Now, interpretation of R squared and P values, which showed 51% of the variation in ESG scores was explained by pooled OLS model with gross NPA and net NPA being the most impactful financial predictors. And despite financial metrics playing a role, the remaining 49% of the variance is unexplained, likely influenced by non-quantitative factors such as direct shareholder activism and regulatory actions. Once analyzing the results, we concluded that mostly the shareholder activism significantly influences ESG performance in India's banking sector, financial metrics such as gross NPA and net NPA playing crucial roles, and governance quality shows the strongest link to financial discipline as evidenced by an R-squared value of 0.95 for governance scores. Larger banks face more scrutiny on ESG practices, while smaller banks outperform in certain areas due to greater flexibility and responsiveness. So this study actually fills the gap in ESG literature. That is its main contribution by focusing on the post-ballot phase of shareholder activism. This was a major gap identified during our literature review. Hence, we explored on this gap and emphasized that the importance of transparency and long-term ESG strategies are essential for the banking sector. Now, future research should focus on direct shareholder activism metrics and integrate more qualitative data to deepen understanding of the shareholder impact on ESG transformation. So, however, the banking sector needs to concentrate more, given the guidelines like BRSR and the various ESG scores. It needs to concentrate more on this ESG transformation to march towards the sustainability goals, emphasizing especially on the SDG goals, which are, futuristic and impact the global climate change phenomenon to a large extent. So these are some of the references which we had referred to. So while accessing the references, we found that studies of this dimension were very much limited in the emerging economies, especially countries like India. Hence, we decided to focus on these and arrived at the results. Thank you.